Hello guys and welcome to Forex YouTube. In today's video, as promised, I will be showing you how to become a profitable retail trader in the Forex market. So let's get right into it. So open your MT4 platform. Okay. Today I'll be showing you how to become a profitable trader by way of looking at something that is known to almost every retail trader. We'll be looking at a head and shoulders pattern. So let's find a head and shoulders pattern on the chart. Okay, here's one. Let's just minimize this. All right. The book way of trading the head and shoulders pattern is of such. Firstly, let's identify the head and shoulders pattern. So this is the left shoulder. This is the head. And this is the right shoulder. Alright, so based on what is taught in the books, firstly you would identify a neckline which is at the right shoulder. So let's just identify this neckline. So it's right there. Then you would realize where your entry point is. So in this case, your entry point would be at the closing of this candle below the neckline. So this would be your entry point right here. Now your stop loss would be just above the right shoulder, and your take profit would be from the head to the neckline, which is about there. So this would be your take profit point. All right. Now the problem with this is whenever a pattern is spotted by retail traders and is confirmed by retail traders, you can be sure that when this candle closes right here, there will be an influx of retail traders. At least 60% of those traders watching that pair will enter short as soon as this candle closes below the neckline, because this is what is widely taught and this is what validates the head and shoulders pattern. Now, if 60% or more retail traders enter this trade at the point of validation, and 90% of retail traders loses trades, most of the times what is expected is that this pattern will not hold, because retail traders are always losing money. So this means that this validation most of the times will not work. Now, this took me about 5 years to realize. It's not that I did not know that most retail traders lose money. And it's not that I did not know that most of the times price would not go to this point. What took me 5 years to understand was, what was I then to do? How can I then trade somewhere in this area where there is mostly or only institutional trader? And that's what it took me 5 years to realize and understand. Now, forget this trading style, because most of the times what the institutional traders will do is, if there is enough liquidity above this right shoulder, then it might come down to here and then it rallies, or it might just simply turn and take it right out. Now sometimes there will not be enough liquidity above the right shoulder, hence the trade will play out and reaches that take profit. So the institutional traders won't be interested because there isn't enough liquidity to enter the trade. So that is what determines which way the trade ends up. If there is enough liquidity, the institutional traders will return price to the point of liquidity. If there isn't enough traders, then the price will trickle down or goes down to the point where there is a take profit. Now, there is no way to know which way the price is going to go, because there are millions of traders and you do not know the particular amount of traders making a trade on that pair. Now, what you want to do instead is enter the trade when the institutional trader is in the market, and even before the retail traders enter the market. In this way, you can be sure that most of the times the trade will go in your direction. So let's do that. Pay close attention to what I'm about to say, because this is what you need to do. As soon as price touches this neckline, remember, no retail traders will be in the market, or most retail traders at this point will not be in the market. They are waiting for validation at this candle. So as soon as price touches this neckline, you would enter this trade. So let's write that down. So entry at neckline. Your stop loss will not be at the right shoulder. You will be using a stop loss based on the average true range of past price action. So ATR, go to insert, indicator, custom indicator, ATR. Okay. Say at the point when the candle touches the neckline, the ATR is 10. Then what you would want to do is place a stop loss above the neckline 10 pips up, somewhere about here. Right? Let's just minimize this. So 10 pips up would be from the neckline to around here. So it would be just above the entry price. So let's place that there. So stop loss is just above the entry point. Now, the most important part of this strategy is where then would be my take profit? The take profit would be the validation of retail traders entering the market. So your take profit would be as soon as this candle that validates the trade for retail traders to enter the market, that is when you leave the market. So your take profit would be right there. As soon as this candle closes, let's write that there. So once more, let's just go through this strategy again. Instead of entering the trade when you have this validation candle, placing your entry right here, your stop loss right here above the right shoulder, and placing your take profit down here, what you should actually be doing is placing your entry as soon as price touches the neckline, using an ATR stop loss, and taking a profit as soon as the validation candle is completed. When this candle, which is validating the pattern, is being formed, most of the times it is the institutional trader that is setting a trap for a retail trader, in my opinion. Even if it's not the institutional trader and it's only persons trading, then once this pattern is developed, then it can be exploited by institutional traders. And how it will be exploited is when this pattern is completed and validated, then retail traders will enter the market. Most retail traders will enter the market, and price then can be returned to the point where most retail traders will have their stop loss, which is right above the right shoulder, and this will in turn provide liquidity to institutional traders. I hope everyone have come to the realization why it is not even good to trade patterns when trading the market, because most of the times you will not reach anywhere. You will not gain any profit from doing so. So hopefully, as a retail trader, this will open your eyes and you will understand that you got to trade the market smartly. Okay, so let's now go look at my back testing chart and see what I made. Okay, so let's just open it up from 2015 to 2023. I'm just gonna open all of them at once and then I'll just go through them. Okay, so let's just start with 2015. So as you can see, the first of the first 2015, initial deposit 10,000, and my closing was 50,000. So this is the balance, 50,000. So I close with a profit of $40,000, which would be a 400% increase for the year. In 2016, I also started with a 10,000 deposit, and I closed with a balance of 49,000 and I made a profit of 39,000 for the year, which would be 390% return. Let's just go back to 2015 just to point out that my profit trades for that year were 73%. So I won 73% of short trades and 74% of long trades. So my overall percentage of trade that was profitable was 73%. So it's profit trades percentage of total, 73%. So back to 2016, my profit trade for 2016 was 59.61%. So most of my trading over the years has been roughly about 60%. Sometimes it will be 55, 59, 70, but most of the times I will win at least 6 trades out of 10, which is 60%. And based on what I know and what I have seen and heard, that's as good as it gets. So let's go to 2017. In 2017, I started with 10,000 and I closed with 29,000. So I made a profit of 19,955, which is 190%. And my profit trades for that year was 62.15%. 2018, I started with $10,000 and I ended with $32,000. So I made a profit of 22,671, which would be approximately 200%. In 2019, I started with 10,000 and I ended with 25,000. So I made a profit of 15,713, which is 150%, and my profit trades percentage of total was 59%. In 2020, I started with 10,000 and I ended up with 31,000. So I made 21,000 profit for the year. My profit trades were 64%. In 2021, I started with 10,000. I closed with 30,780 and my closing profit and loss was 20,780, which is 270%. In 2022, I started with 10,000 and I ended with 70,000. So my profit was 60,000 and my profit trades was 70%. So I won 7 out of every 10 trade. For 2023, I started with 10,000. So let's just elaborate a little more since this is the last one. So I started with 10,000. I made for the year 233 trades. So it's the same right across the board. From 2015 up until this point, it's usually about 150 to 250 trades that's taken yearly. So I made 233 trades so far for 2023. I made so far $28,084. So my profit and loss so far has been 18,000, which is 180%. Now my profit trades has been 64% so far. So it can go up, it can go down. Now I want you to pay attention to this graph. In the beginning of the year, I was losing trades, losing trades, losing trades, losing trade. Then I started to win trades, going right up. Then I lost more trades than I won back trades. This is the process of trading. You will lose and you will win. But your strategy has an edge where you will win more than you lose. So this is how, as a retail trader, you can be profitable and you will be profitable. It's just having an edge in the market. And once there is an edge, then you will develop a consistent profit-making machine. I'll see you in the next video. Until then, take care.